Hello, everybody, and welcome. I am Hammer with today's Vetted VA Mortgage Market Update. Joining me on this lovely June 21st of 2023 is our guest, Clyde Penton. Everybody, please work with us. We're having a little bit of technical difficulty. Clyde doesn't necessarily hear me very well, but I think he's hearing me now. So, Clyde, thank you for joining us. And if you don't mind, if you want to take a minute and just introduce yourself to everybody and tell them a little bit about yourself.
Hey, good morning or afternoon, depending on where you are. My name is, hope you're doing all right today, Hammer. Hope everybody's doing all right out there today as well. My name is Clyde Penton. I am a 15 plus year mortgage professional, currently with American Pacific Mortgage, and I'm a member of Vetted VA. And yeah, that's a little bit about me. I live in Monroe, Georgia, here in the Southeast, and I'm from the South, and have all girls, so I'm a girl dad through and through. And yeah, that's a little bit about me.
Awesome. Well, thank you for joining us today, Clyde. I do actually have a good question for you. We're going to get to that a little bit later. We're going to cover all the rate stuff first, and then I did post in the Vetted VA Facebook group asking if y'all had any questions for us to answer today, and we did get a question, so we're going to go ahead and answer that. Otherwise, let's go ahead and if you guys do have questions and you're here live, please take a minute and go ahead and tell us hello. I see many of you are in the comments. Go ahead and tell us a little bit about yourself, whether you're a consumer or a professional. I see we've got some people from each of the different groups. So go ahead and share that. And if you're here live, say good morning or good afternoon. Let us know that you're here. If you're watching on the replay, do me a favor. Just give us a hashtag replay in the comments. We see that many of you do actually view this after we've aired it live. Love to hear from you in the comments as well. So with that said, let's go ahead and dig deep. We missed last week. I was at the Vetted VA Summer Camp. That was an awesome thing, by the way. If you guys have an opportunity to go, please go ahead and go, professionals and veterans. So anyway, rates have been basically unchanged over the last couple of weeks. They've been moving up or down about 0.25%. So that's really not a lot in our world. Rates generally for VA have been in the mid to high sixes. If you've got really good credit, you may be able to get something slightly below that. But generally, if you're getting rate quotes somewhere in the mid to high sixes, that's right on par. That's exactly what we would expect to be seeing right now. If you go ahead and are looking at getting a conventional loan for some reason, rates are going to be a little bit higher. They're going to average in the high sixes into the low sevens, depending on how much you're able to put down and your credit score. But overall, rates really didn't improve much last week, even with inflation data showing that inflation has improved a bit. And after the Fed meeting, despite the Fed taking a break from hiking rates, I want to take a minute and kind of go over why that is and why we didn't see a big difference. So if I look for CPI inflation, and I'm just going to Google this live with all of you on the call here and show you, I'm going to go to some of the news articles about it. There were some really, we want US. So let's see, let's put US inflation here. So, this was an article. It would make you think things are fantastic, right? On CNBC, it said inflation rose at a 4% annual rate in May, the lowest in 2 years. Now, for those of you that are new to watching, we've talked about in the past that inflation is actually one of the drivers on mortgage rates and why we see mortgage rates that go up or go down like this. So when you see this, that this is the lowest rate in 2 years, that's a great headline. The problem is it doesn't tell the whole story. So this is the actual U.S. Bureau of Labor Statistics, or what we call the BLS. This is where that CPI inflation data actually comes from. And I want to show you guys this particular chart right here. If actually, we'll just click on charts, make this a little bit bigger. All right. I want to show you this chart here. And you will see that most of the inflation, all items as they call it, were up. The food categories and major categories were up. The other major categories were up. It was only energy that was down. Energy being generally, fuel prices, gas prices, that was down quite a bit. And that helped bring the overall, what we call headline number, down significantly. But what we're really looking at, what the Fed is looking at, what's driving interest rates, is not this what we call headline number of all items, which was 4%. If I hover here, in May, it was 4%, which was the lowest we've seen in quite a while. And it has significantly been going down since topping out in June of last year, a year ago, at 9.1%. We've seen it get lower and lower and lower and lower, which looks really great. The problem is that doesn't tell the whole story. What we look at is what we call core inflation, which removes energy and food prices because they tend to be more volatile. They bounce around quite a bit more. And if we take a look there, we can see that in June of 2022, we were at 5.9. And then it actually went up after that, capping out at 6.6% in September, and then worked its way down, but it has stayed within this fives. It's been 5.7 in December of 22, then 5.6, 5.5, 5.6 again in March. You see it actually creeping higher, 5.5 in April, and only going down to 5.3 in May. So again, it is actually moving in the right direction. It is lower than the month before, but there wasn't really a large movement there. And that's why, even though we've seen some headline data like this, that's why we didn't really see mortgage rates improve, because this doesn't tell that whole story. Now, the other thing is that the actual Fed themselves, they have come out and said, hey, we think that in order to fight inflation, we're going to need to continue to raise rates. Now, at that last meeting last week, the Fed paused rate hikes. The Fed has hiked rates at 10 consecutive meetings before that June meeting, and over the course of 14 months. This was the first meeting that they paused, but right now, markets anticipate that the Fed is going to raise rates again in July. Now, at the meeting last week, they never are really clear. We have to read through the lines on what they say. But during the meeting and in Fed Chair Jerome Powell's press conference last week, he came out and made clear, and many of the members made clear in what they call the dot plot. So if I look for, I'm going to Google Fed dot plot for you, and I want to show you this actual Fed dot plot. And I can actually pull this up, I think, here in CME. So let me do this chart right here. All right, so I'm going to show you that, and let me zoom in on this so you guys could see this. So this is what you want to be looking at if you want to forecast where mortgage rates are headed, and I'll tell you why. So each of these dots is a Fed member that said, hey, this is where I think rates are going to be in 2023, in the end of 2024, at the end of 2025. So at the end of 2023, the Fed funds rate right now is currently at 5.0%, right? 5%. There were most of the members that figured it was going to be above this 5.5 line. We've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 members that figured it was going to be above 5.5. And then another 4, which would bring us up to 16 of the 18 that thought it was going to be between that 5.25 and 5.5, and so above 5.25. Notice that none of them felt we were going to be below 5% at the end of 2023. So most of the Fed members anticipating that the Fed is going to have to hike rates in July and most likely again in September. Now, the market, or this is what we call Fed futures. This is what the markets are currently expecting. Markets are basically an 80% probability that the Fed is going to raise rates in July, and that in September, they're anticipating that the Fed will hold rates at that 5.25 mark, 5.25%. There's about a 15 or 16% probability that we'll see another rate hike in July, but it's not that high right now. There's also a little bit of a belief that the Fed would have to cut rates by the September meeting, rather. And then once we get to November, same thing. Expectations that we'll be at 5.25. And by the time we get to December, it stays about the same. About a 50% expectation will be at 5.25. Now, why do I show you guys all these fancy charts? Well, this really has to do with what we think is going to happen next. Rates are not likely, and this is our rate forecast. All right, so rates are not likely to drop much from here because the Fed is expecting to raise rates again starting at that July meeting. And Fed members are forecasting 2 or more rate hikes this year. Markets are currently only pricing in 1. And we've talked about this at past shows, but if this is your first time watching or you didn't see those, mortgage rates aren't going to move when the Fed raises rates. Mortgage rates move in anticipation of what traders think the Fed is going to do. So Right now, markets think the Fed is only going to raise rates one time, even though the Fed and all the Fed members have said, we think we're going to raise rates twice. So why would the Fed think, hey, why would the markets rather think that the Fed is not going to raise rates twice, even though the Fed members have said they're going to? Well, they think that the economy is slowing down and that the Fed is going to see this economic data and that they're going to basically make the decision to pause again. And there's a lot riding on that. Now, mortgage rates not likely to go down until we see expectations that the Fed is done raising rates and expectations that the Fed may actually start to cut rates again in order to jumpstart the economy. In the past, we've talked about recession and how recession will actually help mortgage rates. The problem is every time we get one report that shows the economy is slowing down, any kind of economic data showing the economy is slowing down, we get another report that follows up that shows the economy is actually doing pretty well. Because of that, it's very unlikely that we're going to see mortgage rates fall significantly from here. So if you're out there house hunting, if you've been, restationed, don't be surprised to look at these rates or very similar rates over the next few months, possibly higher rates. We may see VA rates that go into the high sixes or could even touch the low sevens, depending on how strong the economy continues to be. So that's really what's been driving things lately. And one more thing that I'll leave you with before I bring Clyde back into the conversation and we chat a little bit more is, when we look at kind of what's going on again, actually, I didn't update that slide, so I'll just say this one verbally. So the bottom line is that we are looking at an environment where rates are more likely to hold steady or increase rather than decrease unless we see a shift in sentiment, meaning that markets expect the Fed to go ahead and be able to cut rates. In order to see that, we would need to see the jobs data that comes out in July, which will be on July 7th. We would need to see that jobs data showing that the labor market is weakening. Unfortunately, we would have to see people struggle, layoffs, unemployment increase in order to see rates start to improve. It's a very necessary and unfortunate part of the economic cycle is that the economy will only cool down when people stop spending money. People generally stop spending money when they're afraid they're going to lose their job or they have lost their job. So unfortunately, that's what the Fed is currently looking for. Now, Fed Chair Jerome Powell, he's out there today testifying in front of Congress. He does that twice a year. And he's going to start out today. He's at the House of Representatives in the Financial Services Committee. Tomorrow, he'll be in front of the Banking Committee for the Senate. And he's going to basically repeat himself tomorrow. But basically, the Fed has been out there saying, hey, inflation still a problem. We've taken a break for 1 month to see, just to let things catch up and see what kind of effect it's having. But we anticipate having to raise, that Fed funds rate twice more this year. Markets think the Fed is not going to be able to follow through on that because the economy is slowing down. I personally don't necessarily agree with that. I think it's an optimistic view. I don't think that the economy is slowing down. We've been talking about a recession coming for a year now. And we were having the same conversation in June of last year. And, all the indicators were pointing to a recession, but yet I don't feel very recessed. Clyde, how are you hearing me these days?
Much better. Yeah, much better.
Okay.
Yeah, I can hear you
looks
loud,
like you're on your
loud and
computer
clear.
now.
Yeah,
Okay.
loud and clear. Yeah.
Awesome. So, now that you've heard me kind of, carry on for a while, what are you noticing in the market? What are you, when you're quoting rates to consumers, are you finding that your rates have stayed relatively the same or how are they moving?
So they've stayed relatively the same for the past, I would say, 3 weeks or so. I'd have
Sounds
to go
about
back
right.
and look and see because I had some contracts that were coming, and
Mhm.
they didn't quite come for about a week, and there was a change.
Yep.
About a quarter of a point in rate change. And now they stayed relatively steady since then. Maybe a slight improvement, but nothing substantial. It's been
Yeah.
kind of just a little bit of a wave, a little bit of a slow
So
wave as far as a little bit better, a little bit worse. As far as interest rates go, that's what I've seen.
yeah. And do you think that we are likely to see rates drop significantly? And when I say significantly, I mean more than 0.25%. Do you think we'll see rates drop significantly anytime soon, in your opinion?
Soon? No. 12 months, probably, but not soon, soon. Not
Yeah.
I would determine if I was going to change my timeline on buying a home based on the interest rate. I don't believe that's the case. Um,
Yeah.
yeah, I don't think that's
Asking me in the past, I was thinking we would see a more significant rate drop at some point as well, but I'm starting to doubt that. I really am. I don't know that we're going to see that big of a recession. I mean, maybe that somebody's pulled the fire drill too many times on me, but I feel like Chicken
yeah,
Little, all the big names, and uh, again, it's kind of like everyone says, if anyone knew what was going to happen, they wouldn't be doing shows like this. They'd be on an island drinking heavily. But the reality is that everybody that's out there has said, "Oh, hey, we're betting on a recession," and I was on board that boat for a long time, and now I've kind of jumped off the boat. I just don't know that I think a recession is going to come. I don't think rates necessarily are going to slide that much lower. Maybe we see some VA rates in the high fives again, but I think that's a maybe, not a definite at this point. Gotta see.
yeah. I
So
mean, who can tell, right? Yeah, who can tell, really?
So I have a great question for you. This was I had posted this, that we were going to be doing today's show, and if anybody had any questions ahead of time. So this was from one of the members of the Veta VA community, and she said, "I currently own a home in New Jersey with a 2.365 rate on a 15-year loan. I have orders to leave and intend to buy at my next location. Can you give me insight on whether I should sell, rent it, or refinance it to a 30-year loan? Wouldn't allow me to put in more than 200 characters, but it's or refinance it to a 30-year loan." So um, I think that this is a great question, and for those of you watching, you may have this opportunity or you may have this situation come up. So, Clyde, let's discuss it a little bit. The first thing I want to talk about, though, before we talk about the math of this,
Mhm.
is the VA eligibility and using your VA loan for more than one home. Are you and I know I'm putting you on the spot here, and with guidelines like this, it's sometimes something that you'd look up to make sure that you're referencing, but are you comfortable discussing, what a veteran's eligibility is if they currently have a VA loan and they want to buy another home?
Absolutely. That's
Okay.
a significant number of our VA homebuyers
Okay.
are realizing they can own more than one home. They don't want to get rid of a home because they have a really good interest rate on it. There's a number of reasons why they want to keep them. Maybe they want to start building their portfolio for retirement eventually. Various things, but yes, absolutely. Yeah.
So then, can somebody use their VA if they currently have used their VA eligibility on a primary residence and they're restationed? Can they go ahead and use a VA loan to buy another home?
They certainly can. Couple of things that they have to be aware of though. So when they're moving to their new duty station or just moving to a new location in general, it doesn't have to be a duty station, right? But when they're moving and they bought their home with their VA home loan as a primary residence, and then they're moving and they have to buy another home as their primary residence, they can use their VA home loan again, but there will be a limit as to the amount that they can borrow without a down payment. What that is based on is your eligibility, and then there is something called bonus entitlement. So you have bonus entitlement, and that will vary based on the location that you are buying the home now. So, somebody buying in Hawaii may have a $1 million limit on purchase power. So they would use that as the factor to figure out how much they can buy without a down payment. If they have to put a down payment based on their remaining eligibility, what you're typically going to see is a 25% down payment of the difference. So let's put it in numbers. Bought a home in New Jersey, let's say for, I don't know, depending on the part of New Jersey, let's just say 400,000, right? They
Right.
bought a home for 400,000. They're moving to another area that has the standard limit, right, of 726,000 and some change, right? So they have 326,000 roughly that they can buy without a down payment. If they want to buy another home for 400,000,
Okay.
they're going to realistically need to put a 25% down payment of that 74K difference. So around 18,000 ish, something like that, that they'll have to put, or 16, 17,000 actually, as a down payment that they'll have to put down in order to purchase using a VA home loan for that price. Again, if they bought for 326, they should be good to go without a down payment if they already bought for 400. But that can vary based on location. Some areas, California, Utah, just various areas have higher purchase limits. So.
Right. So this sounds like a very confusing topic. If somebody is contemplating this, who should they talk to try to find out and do the math on that rather than trying to do it themselves?
I would highly recommend. I would recommend reaching out to a vetted professional. A little bit biased here, but I'd recommend reaching out to a vetted mortgage professional. Not not that any vetted professional can help you, but a vetted mortgage professional to help you with that calculation. There's actually some worksheets that can be used, and they can show you the actual information from the VA website. They can run through those numbers with you and make sure that you fully understand what you're able to purchase and what, if any, down payment you will need for any secondary, or even there are some people that are buying 3 homes depending on where they live and what the price of the homes are. So.
Right. So, again, this is a complex question. The first thing that starts out with is, before deciding, what to do with this current property, is to decide, what would it take to get your foot into the door in the next station, right? And is that feasible? Because if it is going to require, as your math did, $18,000, is that feasible? Do you have that money? Can you come up with a down payment? Now, if not, well, you've also got other options. You could consider buying a home and not using your VA entitlement. You could buy a home with an FHA loan with a lower down payment, or maybe with what we call conventional financing, which is Fannie Mae, Freddie Mac financing, which can have sometimes as low as 1% down. There's a couple of odd programs out there, but generally, as a rule of thumb, 5% down is going to be a general rule of thumb on that. But when you're talking 25% to 5%, we're not talking apples and apples, because you said it's 25% of the difference. And that's a big difference. So on that, we said a $300,000 house. Well, 5% is 15 grand anyway. 18 grand was the difference on the VA loan. So it almost puts you in the same category as well. So all of these, finding out and exploring these options, I agree, for unique situations like this, find a vetted VA professional, mortgage professional in your state. Go to the vetted VA website, use the interactive map, find somebody that you're comfortable with. Of course, you could always look at other companies, but, without saying anything negative, big companies that have like those initials, like, I'm just going to call it like Veterans United. I don't know that I necessarily would always take the same, credibility in their answer. There's a lot more people that are a lot less trained. That's my concern. So that's why a vetted VA, member is definitely going to be able to show you where the guidelines are and what those requirements actually are. So once you've figured out what it would take to do that, remember, if you couldn't swing that, you don't have a down payment, it's not going to work. You could sell the home in New Jersey, and then you could use 100% entitlement again and buy your home in your new place. So that is an option. And so you've got to look at your unique situation, your cash flow, your savings, your assets, what's going to work for you. And do you have the ability to do that? Now, let's say that you do have the ability to bring some money to the table. Clyde, do you think that somebody that has a low interest rate, 2.365 on a 15-year loan, which again means they're building equity very quickly. You build equity much, much faster on a 15-year loan than you do on a 30-year loan. And over time, you pay a tremendous amount less interest because you're paying 15 years worth of less of interest. So do you think that somebody, you mentioned like having retirement or setting themselves up, what's the benefit of owning a home as an investment property if you are restationed and you move?
Benefits, a few of them potentially, but again, building equity for retirement if you want to keep. So 2 things: building equity for retirement or building cash flow for retirement. So if you've got a 15-year loan, chances are, if it's a 2.365, chances are that loan is at least 15 years old. I mean, a year and a half old, 15 months old, 18 months old. Yeah. Probably
from 2021. I agree.
Yeah. If they've got 2 years into this loan, right? If they're 2 years into this loan, they're already, 10% of the way, over 10% of the way. They're 12 or 15% of the way on having that home paid off, right? Then you start looking at, so the equity position, right? If you want that home's worth $1 million by the time you retire, right? Then you have, a home you could sell for $1 million or put into a trust, figure out, talk to a tax professional, right? Don't get hit heavily on taxes or whatever the case may be. But
Right.
I digress. You gain that equity for retirement, but then you also want to look at things like cash flow, which kind of blends not only with retirement, but also with your current situation. So the retirement aspect, if this home is paid off in 13 years, if you're renting it out for, I don't know, $4,000 a month, that's $48,000 a year minus whatever it costs you to maintain the home that you are generating as revenue for yourself. I mean, will $1 million even generate that much income for you? Probably, but 48K is pretty solid. So anyway, that's the ways you can look at it for retirement. As far as right now, renting it out, that was another part of the question, and I don't want to get too far into that. If you have some other other things you want to add there, Hammer, but that's what I see. So building equity to where you could sell it and figure out a way to use those funds to fund your retirement, and also getting it to a cash flow position which is completely positive, if you will, besides taxes and insurance that you have to pay in 13 years or so from now. So goodness, man, it's a great position to be in if you have a home that's going to be paid off in 13 years in a good rental market.
Right. And also, the one thing we didn't talk about, as far as we talk about down payment on a new home, but remember, there are qualification requirements for income to carry both mortgages, but you would be able to use some of the rental income to offset that that liability of the expense. So as far as the market goes, what are your risks? Well, what if the values of homes went down significantly? You could end up, but with a 15-year note, that's very difficult to get in trouble with. I spent over 30 years in New Jersey before moving here to North Carolina 6 years ago, so I could tell you that New Jersey, even still, and I have one of our I have family that are still in New Jersey. It's not a market that you have to worry about losing value on. Whether this person may be up in Northern Jersey for Picatinny Arsenal or Southern Jersey for Fort Dix, either way, both those markets, very strong markets. So it's if you have the ability and desire to do it, it could be a very good move. You want to, again, discuss it with a professional for your unique situation. But yes, as far as like refinancing it to a 30-year, that I would not consider doing, because you're going to give up that very low interest rate that you have now. And you're going to get a lower payment because you're extending the loan over a longer period of time, but you're going to be paying so much more in interest because you're going to be in today's current market interest rates instead of that 2.365 rate that was only around in that pandemic window and we probably will never see again. And you'd be giving that up. So I wouldn't refinance. Clyde, would you refinance to a 30-year? Did I miss anything on that one?
I would not touch that interest rate right now. To your point of what you said, I just ran some numbers really quickly because I numbers, I want to do them. But yeah, I mean, you're talking about maybe, I don't know, maybe 150, maybe $250 less a month in total payment. I can't see where that would be valuable enough to pay the cost of closing and extend your term out. Like your cash flow is not being changed enough.
Yeah. So,
in my opinion,
and then, I mean, selling it, the beautiful thing is that you've been, if you to get that rate, like Clyde pointed out, it's probably a couple of years ago. We've seen a very strong growth in market values over 2 years, more so than normal, way more than normal. So with the equity that you've built, taking on a 15-year loan to begin with, which was a great decision. For those that can swing it, a 15-year loan is a great loan. And the equity that you've built, as well as the market equity that has gone up for values, if you are selling it, you're going to be in a good situation. The problem is, depending on how long you've been in that home, you may be paying some kind of capital gains. I think to avoid capital gains, you've got to be 3 out of the last 5 years. It's got to be your primary residence. Clyde, 2 out of the last 5?
I'm not a tax professional, but 2 out of 5 years is my understanding. Yes.
Okay. Yeah,
I know. I sold a home. I sold a home that I lived in that I owned for about 2 years and 4 months, and we were good to go.
Yeah, and that a quick Google search can help answer that question as well. As though, again, that is a tax question, not a mortgage question. So you want to make sure that you do discuss it with a tax professional. But you wouldn't have short-term capital gains, which is under a year or under. You'd have longer-term capital gains, which is much lower rate than that. But even still, something to factor in as well. So I think without putting words in Clyde's mouth, but from what you've said, Clyde, if somebody has the ability to swing it, it would, it's something to strongly consider as a way of building wealth and, having an asset as you get older. It's a great, you bought a house at a great time with a great rate, with great values, and even if you are forced to sell it now, you'll still do well, but holding on to it, I think will pay out even better. Clyde, what did you think on that?
I agree. Yeah, I agree. Yeah, if I could figure out a way to keep it, I would keep it. That would be my thing.
Hopefully, Kelsey, that answered your question. I will point you to this recording, but if anyone else has any questions, we would love to answer those live. Go ahead and pop them on the screen. I'll give you guys a minute to do that. Otherwise, I'm going to go ahead and wrap it up for this week. Clyde, thanks again for joining me. Sorry that we had some issues at the beginning. Glad you were able to get those cleared up so we could have your full input today. So anything you want to leave everybody with?
Oh, not too much. I appreciate you having me, Helmer. Thanks so much for bearing with me on the technical issues on my end. I thought everything ported over on programs and things when I shared them or imported them over. But I guess parting things. Just make sure you're educated. If you have questions, ask. That's probably the biggest thing. There's no question that is a bad question or anything like that, right? Just ask questions. And if you don't ask questions in the Vetted VA group, ask questions somewhere until you get a real answer. Because having the proper information and having an educated perspective on things is going to be helpful for you when you make a decision to buy a home, sell a home, rent a home out, whatever it is that you're looking to do. Just make sure you ask questions and get yourself the proper information.
Yep. Christopher Griffith says this is a place of human intelligence. Hopefully we've been able to bring y'all some this week. And again, we come to you each week. You can join us each and every week at the same time, 1200 Eastern, to go ahead and cover what's going on in the rate markets, why you're seeing it. We're here to answer all of your questions. If you have questions about why mortgage rates are moving in the directions they are, or what's kind of causing that, we're here to answer those, as well as some of the other housing questions for you. So thanks again, Clyde. And I'm going to wrap it up. Everybody, we'll see y'all next week. Take care, everybody.
Have a good one, guys. Yep.